Imagine a world where Bitcoin is already worth several $100,000. Many people believe that's exactly where it should be, if it weren't being manipulated. A growing theory suggests that major financial institutions, especially large banks, are quietly keeping Bitcoin's price down. You may have seen the outrage online, people accusing big banks of shorting the stock of MicroStrategy, the massive corporate holder of Bitcoin. MicroStrategy's entire strategy is simple: raise money, buy Bitcoin, and hold it. But recently, its stock price dropped so low that the entire company was valued at $10 billion less than the Bitcoin sitting on its balance sheet. In other words, buying shares of MicroStrategy was like buying Bitcoin at a discount. At first, this sounded like just another rumor, but the deeper you dig, the more this story connects to something much bigger, an old financial phenomenon known as the death spiral. And history shows that when this spiral begins, entire nations, companies, and empires collapse under it. So let's unpack how this ancient financial trap may be quietly shaping Bitcoin's future today. Back in the late 1800s, the Ottoman Empire borrowed heavily from French and British banks. Their debt was denominated in gold, a currency they couldn't print. When a global financial crisis hit in 1873, their borrowing costs skyrocketed, their local currency weakened, and everything priced in gold suddenly looked more expensive. Eventually, the empire couldn't pay, but default didn't end the story. It triggered something worse. Western banks forced the Ottomans to surrender control of their tax system to a foreign-run institution. The empire lost financial sovereignty. It became a prisoner of its own debt. Fast forward to 2010. Greece faced a similar crisis. After borrowing hundreds of billions of euros, a currency it didn't control, its economy collapsed. As borrowing costs surged, the IMF stepped in and required Greece to transfer ownership of its most valuable national assets to a special fund designed to liquidate them for debt repayment. Both of these stories are examples of the death spiral, a scenario where a weakening currency or falling asset value forces the borrower to sell even more of what little they have left, pushing prices down further until the system collapses. But this is not just something that happens to nations, it can happen to companies too. In the early 2000s, regulators uncovered a financing structure that resembled this spiral and destroyed hundreds of companies. It was called a PIPE, a private investment in public equity. The most dangerous version of it involved floorless convertibles. Here's how they worked. A struggling company needed money. Traditional lenders wouldn't help, so a hedge fund offered cash in exchange for convertible debt that could turn into company shares. The twist: the lower the company's stock price went, the more shares the lender received. This meant lenders could short the stock, push the price down, receive even more shares in the conversion, then sell those shares again, pushing the price down even further. Over and over, the company got crushed. The SEC reviewed hundreds of cases and found that investors lost an average of 34% within a year. Nearly half of those companies were delisted. Many never recovered. Why does this matter? Because MicroStrategy today carries billions of dollars in convertible notes. And while the terms aren't identical, the risk comes from a similar structural pressure. What happens when MicroStrategy runs out of cash while its stock trades below the value of its Bitcoin? That's where the fear of a modern death spiral begins. To understand the risk, you have to look at MicroStrategy in simple terms. It's essentially a giant Bitcoin holding company with a software business attached. Today, it owns around 650,000 Bitcoin, worth roughly $59 billion depending on the day. Against that, it owes about $16 billion in obligations, very manageable on paper. In fact, its loan-to-value ratio is around 11%, which sounds incredibly safe. But there's a problem. Servicing that debt costs roughly $800 million per year. That's over $2 million per day. The software business alone cannot produce that kind of free cash flow. So where does the money come from? MicroStrategy built a $1.4 billion cash reserve, and this reserve is designed to cover roughly 21 months of interest and dividends without touching a single Bitcoin. That runway is the key to understanding everything. MicroStrategy has two possible futures depending on one critical number, MNAV, or the multiple of net asset value. When the stock trades above the value of the Bitcoin backing it, MicroStrategy issues more stock. Investors willingly pay a premium. MicroStrategy collects cash. Bitcoin accumulation continues. But if the stock trades below the value of its Bitcoin, issuing stock becomes impossible. It would be like selling $1 of assets for 80 cents. So MicroStrategy stops selling shares and begins burning through its cash pile. And if the cash pile runs out, the only option left is to sell Bitcoin. Selling Bitcoin pushes the price down. A lower Bitcoin price makes MicroStrategy worth less. That forces more Bitcoin selling later. The cycle feeds itself, exactly the structure of a death spiral. This is why people are worried. So, why isn't Bitcoin at $200,000 today? Because two opposing forces are clashing. On one side, MicroStrategy's model benefits from rising Bitcoin prices and strong stock valuations. On the other side, traders, short sellers, and some banks may benefit from keeping the price suppressed. At least, long enough for MicroStrategy's cash reserves to drain. Some believe large banks are intentionally shorting MicroStrategy so they can eventually buy its Bitcoin at steep discounts. There is speculation that major financial institutions are influencing sentiment, publishing negative research, and amplifying fear. So far, there is no proof of a coordinated attack, but history shows that collective incentives can create outcomes that look coordinated, even if no single actor is pulling all the strings. Hedge funds have openly shorted MicroStrategy, traders bet against Michael Saylor's strategy, others simply follow technical patterns. Each group has its own motivations, yet together, their actions may be pressuring the same weak point in the system. Whether intentional or not, the effect is the same. Bitcoin's largest corporate holder faces structural stress that could affect the entire crypto market if triggered. Nobody knows how this ends. Maybe Bitcoin continues to rise, keeping MicroStrategy above its danger zone. Maybe the cash reserves last long enough for a new bull cycle to take hold. Or maybe the price gets pushed low enough, long enough, for the spiral to activate. Some believe this tension is actually bullish, that negativity is fuel for future price discovery. Because if everyone believed Bitcoin was destined for $1 million, it would already be there. What do you think? Will the death spiral remain theoretical, or will it become the catalyst for one of the biggest shakeups in Bitcoin's history? Share your thoughts in the comments, and if you enjoyed this breakdown, don't forget to like and subscribe to Express Econ Geofinance Insights for more deep dives into economics, crypto, and global finance. Your engagement helps the channel grow, and I'd love to hear your perspective.